Right, good morning to our wonderful audience, and thank you for joining the second day of our Offshore Investment Managers webinar. It's great to have you all back with us again, and thank you for your continued support. Last week, we heard the views from the likes of Randmore on opportunities in value stocks, Fairtree on how global credit still offers great value as a diversifier, and the likes of Blue Alpha at the intersection of growth and quality, and how one should focus on the fundamentals or the abilities of companies to grow earnings through any cycle. Today, we have another lineup of some of the top global managers from across the world dialing in with their views and how they are able to make a difference in client portfolios and adding value to investors. On screen now is the agenda for the day. Heather, if you can put the agenda up, there we go. All presenters and presentations will be recorded. We're going to post it as usual on the Boutique Managers website. So the recording of the previous week is there already. We'll upload this one probably the next day or two. And next week, day 3, we will upload in coming weeks to follow as well. Even though the session today will be very fast-paced with limited time, you're still welcome to post questions in the Q&A bubble, and we'll endeavor to cover most of those questions as we can, time allowing. That's it for our first speaker of the day, a man that needs very little introduction. It's my pleasure to welcome Anthony Ginsberg, Managing Director at Kings Global. I wanted to say good evening, Anthony, but it's already pumpkin time where you are, past midnight. So it's already good morning again. Right. Anthony, how are you keeping?
Not at my best, hopefully, but this time it's a bit earlier. Thank you, Eugene, for making it a bit better. Greetings from sunny Los Angeles and the summer here in California, where it's regularly 35 Celsius. And actually, the outlook for the US is remarkably improved since I last spoke to you guys. I've got a couple of slides on the US, Eugene, and then I can also segue onto our fund with you. I'm just to see if I can share.
Yeah, fantastic.
Screen.
If you're ready, we're ready for you.
All right.
Again, thanks for dialing in at strange hours, like usual. We really appreciate it.
All right. So let's just see if the screen share is working. I see it's one of your colleagues may just have to let me in to the screen share. Let's see.
You should be able to share now, Anthony. Let's try that.
The other participant is sharing, it seems to say. Otherwise, I'll just rely on your colleagues to.
Yeah. Otherwise, we can pop it up from our side.
Here it goes.
Anthony.
Okay. There it goes. Maybe it's just the US delay. We'll blame it on the US fibers optic speed here. We don't have 5G everywhere like we should have. Okay, here we go.
Yeah, it's coming through.
All right.
There, perfect. Yes, got it. Got it.
So just a little bit of background, because I know I've spoken to your audience before. We're actually an index product design and product specialist. We do actual index products for insurance companies here, ETFs, mutual funds, as well as banks. And people actually ask me, what does that actually mean, Anthony? So we have ETFs listed on the LSE, the etc. DAX in Germany, Switzerland, and the Euronext. But we've also been doing offshore index funds. We have close to 20 offshore index fund products, and some of them are FSCA approved. And of course, the BCI product, we're very grateful, Eugene, for your team, and Robert, Tanya, and Olga for all the support, because there's almost R1 billion in that product at the moment. And then just something I thought I'd mention is we work with AIG, Zurich, ING, a number of large insurance groups in the US. We've patented some index designs. The most special one is the hindsight index. It typically has 3 indexes, horses in the race, something like a NASDAQ, a Russell 2000, and maybe the S&P, and we are able to essentially have a structure where over a period of 2 to 3 years in a bank product, for example, with JP Morgan or Citibank, throw out the worst performing of those 3 indices. So we'll only credit the 2 best performers. So that's been a lot of fun, and hopefully we can do something with you guys in the future with one of those products as well. So there's typically our principal protected through the banks and the insurers here in the States. That's a a very large industry. It's part of the whole index revolution, frankly. Today we have an area called indexed annuities in America. It's a $150 billion a year industry that barely existed 20 years ago. And interestingly, it's basically a way for the insurers and the banks to compete with the likes of Vanguard and State Street and BlackRock. So it's proliferated, this indexing revolution. It's not just high-end pension funds and institutional advisors who are using indexation. It's become really middle America, places like Kansas and Missouri and Arizona that are also big users of indexation in annuities and life insurance. I'll just go through. I'm sorry if the screen's a little wobbly from the States. Just to thank you and your team again, Eugene. Basically, we have the MSCI World Index with yourselves at 37 basis points TIC, or a TER of 33 bips. And we've been working for almost a quarter of a century now with State Street. We found them to be not only incredibly tight on the tracking error, but another major feature of this offshore product that's domiciled in Mauritius is that there's a massive tax advantage. And that's why we can actually outperform the MSCI World in many cases, because of the tax treaties that we benefit from with State Street. So many people don't understand this, but the benchmark actually assumes maximum withholding taxes out of the US for dividends of up to 30%. And actually, we're able to get this thing down to sometimes 10 or 15% withholding tax. So it makes huge sense to work with a big player that can take advantage of 20 to 25 different tax treaties globally. The MSCI World, as you know, has got almost 1,600 developed market shares. It covers 23 developed markets at this point. Year to date, it's up 16.5. It's actually just around 16.5%. I'm sorry, this is a slightly older slide, but you'll just see the tracking error. People often ask me, how on earth can the blue part of the dollar returns of the fund outperform the benchmark? The answer is this tax treaty explanation. If you're very efficient with tax minimization strategies for cross-border dividends, it can actually boost the return. So although a lot of people are fixated on the TER or TIC, actually the withholding tax rates are equally important, I would say. And that's become a big aspect of indexation over the last decade. I just wanted to touch on the good news story here in the States. What you see living here in, not just in New York, but in Los Angeles, shopping centers, airports, restaurants, they're busy. You don't get a sense that there was really a threat of a pending recession. I know that we had a few wobbles a couple of weeks ago, your colleagues and audience will remember, but actually the US GDP is still on track for growth of at least 2%, possibly 2.5% GDP. The recent CPI, PPI numbers, you all know this, the inflation fell below 3% for the first time in some 2.5 years. So we're actually expecting the September Fed rate cut to be priced in essentially at 25 basis points, with anywhere between 6 to 7 additional rate cuts after that. So many predict by January we'll already have 3 rate cuts. What this essentially means is you're going to have about a 1.5% lower yield on the 10-year and also on mortgage rates, probably by this time next year, which is a real tailwind for the economy and for stocks. And I have to say the Fed's actually under pressure. There are many experts like Mohammed El-Erian and others who you may follow there who are saying that because unemployment is ticking up above 4%, the Fed's actually been a bit slow to start lowering rates. So they're actually under pressure to probably cut at least 3 times between now and January. And we don't see talkings of a bubble. I'm going to get to that in a moment, because many people say, what's going on with the Magnificent Seven? So just to look at the last week, this recovery, you've seen the NASDAQ basically up almost 6%. It's pretty much, the S&P at this point is just under 2% from its all-time high, but it's very distorted by the mega caps and the Magnificent Seven. So if I can just go to that slide and show you, when you strip out the Mag 7, which on their own have a PE of 35 times earnings, which is incredibly expensive by most standards, the PE on the forward PE for the S&P at this point is actually under 17. It's about 16.2 at the present time, if you exclude the Mag 7. So what we see from most experts on this side is that we're not in a bubble. the average PE ratio for the other 493 stocks really hasn't recovered fully. Well, as I say, we're actually averaging under a 17 times PE once you exclude those mega caps. And there's another issue here, which is the smaller stocks and the mid caps are known in the US to perform well, not only during US elections when the Fed typically is more restrained, but also as rates are predicted to come down, it gets priced in that the smaller mid caps and Russell 2000 type stocks tend to finally have a bias and recover. So this just shows you some earnings numbers back during the COVID period, what happened in 2020 and then into 21, and 23 wasn't particularly great, but we're seeing positive earnings around 10% to 14% in the latest second quarter numbers that came through. And one just thing, I know many in South Africa ask me, Eugene, you also get this question probably from time to time, is Europe and outside the US possibly better value for money? And the problem is, if you go back to 2000 with the MSCI World, which is the yellow line, you can probably see it's basically outperformed twice as much as the non-American piece. So if you actually excluded the US, that's the white line, basically it's excluding the US. It's since 2015 and also since 2000, 2001. If you had excluded the US from the index, you basically would have only gotten half the returns. So that's why it's very difficult to time these things. Most of our clients, and we see this in the US, would use MSCI World really as a core piece of the portfolio. They're not trying to time the markets, Eugene. They're typically going in, it's typically core and sticky money. I have a slide from Morningstar coming up, and you'll see actually the guys who are in the index products in the States typically perform better from the active guys because they're not as hair trigger. They basically don't tend to pull the money when there's certain wobbles. They tend to be stickier and more long-term, which is an interesting Morningstar study that just came out last week. So I'm going to just, again, look at this Mag 7 story that many people pick on, which is that if you take them out and you strip it out, essentially the other 493 guys are flat as a pannenkoek, really. They haven't gone anywhere. So to argue that America's in some sort of a massive bubble, you can make a good case that maybe those 7 with their PEs around the mid-30s are very high, but the 493 other stocks, and actually the S&P in yellow really has not moved that dramatically. This is just a slide that I put up previously, and someone asked, can we put it up again? It just shows in yellow all the times that America has outperformed the rest of the world. So the rest of the world is basically only outperforming in orange, and you can see the majority of years, if you go back into the 70s even and the 80s, you really would have done yourself a disservice to exclude the US. So we keep saying use MSCI World as just a core part of your portfolio. You can always overweight with Europe or emerging markets if that's your bent. And I think what's interesting in the States, doesn't get a lot of coverage in South Africa perhaps, is that 70% of mutual funds have closed here over the last 2 decades. So firms like, I shouldn't mention perhaps some of my old companies where I worked. I'm an ex-Barclays and a Solomon Brothers guy, but Merrill Lynch, a number of these firms typically will merge some of their weaker performers. We see this constantly, and Morningstar talks about it a lot in the US publications here. And part of this is this index fund revolution, where unfortunately in the States we've seen up to 90% of large cap fund managers really underperforming, and increasingly this is also true on the global side. So it's not just the low cost of indexing, it's also certain tax benefits that many of you will know about through ETFs, and again on the global side, by utilizing tax treaties, which can actually be effectively utilized when you're not trading constantly. So the index side of the business does have an inherent advantage, because their turnover ratio, many of you know, is much, much lower. Our turnover ratio is about somewhere between 7 and 8% of the portfolio a year. Most active fund managers will have a much, much higher turnover ratio, up to 100%. This is just part of briefly of the index revolution we've seen in the States. At the moment, the latest numbers show the passive number in blue, that line, is over $6 trillion of monies, this is mutual fund monies that have actually moved into the passive realm, and essentially it's moved out of active. There's obviously new money also that's coming in all the time. Another way of just addressing this is looking at the cumulative effect since 2000. What's actually happened? The active market share has essentially shrunk. And at this point, you've got 50-50. It's really active in brown, and the passive assets in green in the US essentially are level pegging now. So it's not as though indexing is running the world, but it's taken a large slice away from active, and it's primarily because the large pension funds and state institutions here have essentially given up utilizing hedge funds, and in some cases they've also moved away from private equity. They found it very expensive. And of course, the active story, this is specific to mutual funds, Eugene. This shows every year in blue the actively managed outflows versus the passively managed inflows in red or maroon on your screen. So basically, the index revolution continues here. There's an interesting book called Trillions that came out by the Financial Times recently, just summarizing this 40-year trend, essentially. Something that I want to just pick up on is what Morningstar have done in the study. If you go down towards the bottom, you'll see in bold there, it says overall passive versus active. And it shows under the total return for, this is the typical portfolio in the US for institutions, 6.7% active over the last 10 years. This is showing up until August 2024, and passive at 8.3. That's not the most interesting part for me. The more interesting part is what I've underlined in red there under US equity. You'll see the active total return was 10.4. This is the average for US equity for active funds, and the passive was 11.2. So, okay, it outperformed by 80 basis points. But then what you see is that it shows under passive 11.0 and under active 9.2. They're both underlined. I'm sorry, I can't highlight them. And what it shows is that the investor return itself, this is also shown on the right-hand side with these light blue lines, the investor return is not as good. It's because people are churning their own portfolios and they're in and out. They tend to be stickier, as I mentioned earlier, on the passive. So yes, you've got 11.0 investor return versus an 11.2% total return. They tend to, it's called the gap that Morningstar categorized, this category gap. And the passive gap is much smaller. People tend to use it more as core portfolios. That's really what this is showing us. And the active stuff tends to be more used as satellites, and people are moving in and out more frequently. That's really the crux of the matter. I just have one or two last quick slides to run through. This is just again from Standard & Poor's showing over 10 years in yellow. If you look at the global portfolios that US fund managers are running here, they've had a bit of a dismal run over 10 years and even 5 years. 91% of US fund managers just have underperformed, whether it's MSCI World or something very similar called the S&P Global 1200 that many of the pension institutions use here. So that's why you've seen this sea change with a lot of the active portfolio suffering and this flow towards the passive side. Another version of this actually more dramatically is the S&P 500, where you see again over 10 years. It's the first row there. You can look at the mid caps and small caps as well. But actually most interestingly is that the large cap, which is the top line, and the overall US equity market, which we call the S&P 1500, both of them over 10 years essentially have really made it very difficult for active fund managers. Around 87 to 91% you'll see have struggled to outperform. And again, just fundamentally, the fee basis has also helped indexing perhaps unfairly, because as many of you know, the indexation costs are incredibly inexpensive. And part of that is that the turnover ratio and the transaction costs are much, much lower. As I said, we're not turning over the portfolio typically more than 6 or 7% a year, versus many active chaps who are it's more difficult for them. So we collaborate with active fund managers here. Many of our investors will be in both. And honestly, it's not really a competition between active and passive anymore. It's seen as a passé argument in the States. We feel like the horse is bolted, and most people in America will typically have a collaborative usage of both indexation and active. And last but not least, I could just show the South African and European story. It's not that dramatically different from the US story. This is a European study by Morningstar and S&P showing somewhere of the order of 94% on the US equity in red, and also global equity highlighted in red. I think it's 96% underperformed. And that's why the South African fund managers shouldn't feel any worse, because it's almost identical numbers. This is 1 year, 3 year, 5 year, and 10-year numbers on the global equity using Morningstar data. Again, it's above 80 to 90% underperformance. Typically, it gets worse over a longer period of time. Typically, 10 years, it really looks quite horrid in many cases. So again, there are many smart active fund managers, my own brothers in that space, and all I'm saying to people is collaborate. There's no reason to knock one versus the other. But indexation has become more advanced with AI, so they can actually cut tax costs with these cross-border dividend flows. Fees are coming down all the time, and there is a significant revolution going on, not just in the mutual fund and ETF space, Eugene, but also, as I mentioned earlier on, insurance groups, the large guys, AIG, Prudential, many others are moving into the space called index annuities or index life insurance, where the underlying cash values are actually tied to indices. So it's become very broad-based, particularly here in the US. And with that, I'll turn it back to you. Thank you very much for your time.
Anthony, thank you very much. And you always make a very strong case as to why to look at using non-actives for your core holding, especially in your global equity carve-out. And as you mentioned, it's an argument of passive versus active, but there's a good space in the world for both in client portfolios. Inexpensive. I think your product very different to a lot of other products. The tax benefits that comes through, obviously adds a little bit more value for clients. Anthony, I've got time for one question, and it doesn't really speak to your product. It more speaks rather to the views on US elections. Your views in brief, impact on the markets if a red or blue team wins. Is a red team better for the US economy and US stocks, or doesn't it really matter? Your views?
Many people would think that Trump is more business friendly, and the Republicans do a big story about being a lower tax party. So most of my business friends, they think often that it should boost the stock market. But truth be told, under Biden, it's done very, very well. And they've done studies going back 100 years and 15 to 16 different presidents. And actually, it's a wash. Over those 4-year periods, it doesn't really matter if it's blue or red. It's actually based on the economy and the health of the underlying earnings. So yeah, I'd love to tell you one versus the other. It's going to be a very close election. As you know, it comes down to about 4 or 5 states. But the main thing here is that people are spending again, the automobile numbers, cars being sold, everything were actually at recent record levels. So we're actually more positive than I would have been maybe 2 or 3 months ago. We don't see any signs of anything other than a soft landing, Eugene. So it's quite positive. There are lots of people who are moving jobs. There's hiring going on. And the GDP should probably hit between 2.2 and 2.5% for the year.
All right, that was one of my questions about GDP, so I'm glad you made a comment on that. Anthony, thank you so much for your time. I hope you get to rest a little bit before your day actually starts. Thank you so much again for your time. We're really grateful. For the audience, the BCI Against Global Index Feeder Fund is on most of all the big platforms. If you want more info, we can always get hold of Anthony if we need to. Anthony, thank you, and keep well. We'll chat again very shortly. Right, for our next session, I'm very privileged to be joined by Ben van Leeuwen, all the way from London. Good morning, Ben. Thank you very much for dialing in. Ben is portfolio manager, for those of you who don't know, at Lindsell Train. Definitely one of the more pronounced and well-established asset management companies in the UK. Ben, again, thank you for your time this morning. I see your presentation is up and running already. So we are ready for you, or if you're ready.
Thanks, Eugene. Brilliant. I'm afraid the weather isn't great here either, but we make do. We're more used to it, I think. Today, I'm planning to talk about this idea of Kaizen. It will be a bit of a shift in pace. It will be much more company focused. And so I'll give you a little break from macro, if that's all right. Here are the usual disclaimer slides to be read afterwards. But before that, I thought I'd just give a couple of introductory slides about who we are as a brief reminder of the philosophy and the history of the firm. Lintel Train was set up around 24 years ago now. And at the heart of the approach is to behave like true business owners. And that manifests in a pretty low turnover rate of around 5% per annum, implying a 20-year holding period for our companies. So as you can see on this slide, we have only bought 6 names in the history of the global strategy, which is the one offered in South Africa, and made 5 sales. And you can see the portfolio names there on the bottom left. So when we are thinking about initiating a new position, it is not done lightly, and you'll likely hear a lot about that company for the following couple of decades. Now, the reason we're able to maintain this fairly unusually low level of turnover is that we only want to invest in high quality companies. And a good proxy for that is a high and crucially a sustained return on equity over time. And as you can see over the history of the strategy, our companies have on average created a return that's double that of the index and maintained that delta over the index despite basically making no changes. So the companies we found were good and have remained good. And all of that for only a modest valuation premium. And here's a little formula to illustrate why we think that continues to be a fairly simplistic but very straightforward approach for outperformance. And all the stars show that if you find a company with this unusual level of higher return, you can pay a higher price. You can even see that higher price regress to the market mean over time, and you will still lock in outperformance thanks to the superior compounding you're able to generate along the way. And those are using the figures from the previous slide. We don't think there are many of these companies, which is good because there's so many to look at. But what that means is we spend pretty much the majority of our time focused on the companies on the left-hand side of the screen. So you can see that 64% of our index are concentrated in areas like application software, beverages, financial exchanges, and so on, compared to just 17% of the index. And then on the flip side, on the right-hand side, we spend very little time looking at certain areas that are more capitally intensive or linked to extraneous things like the oil price or things that we can't really have a view on over 20 years. And that's 3% of our index is concentrated there versus more than half for the index. So the net result of all of this is that we are always going to look pretty different to the index. We have a very high so-called active share, and this can mean that performance deviates considerably over time. And here's a really interesting study just to back up the claim I made about why one should focus just on certain areas of the market. This is actually a McKinsey study. It's a couple of years old now, but the point still stands, and it's one of the longest I've found in terms of the data set used. And they looked at the resilience of return on invested capital for a whole bunch of different industries over this incredible time period from the 60s up until 2007. And you're making money with old friends, basically. You can see there at the very top, pharmaceuticals, software, IT services, beverages, personal products, all the kind of areas that would have worked over that period, we still like investing in today. And you can also see that there are very tight bands for each of these industries. So if you want to get into trucking, for example, it's a structural reality that you will not be able to, on average and the aggregate, earn as attractive a return as you can in beverages, for example. So a lot of what I've said so far probably sounds somewhat familiar and consistent with messaging, but this is where we try to go a little bit further, I think. And a crucial way that we've sought to generate excess returns is not just to buy high quality companies and sit tight, because then any passive algorithmic product could very much do the same, screen for rookies over 20% and do little else. What we've found has been really helpful to generate higher returns is to find excellent companies that have the scope to get better. And there's a really interesting study to back this up by an academic called Michael Malbusin, and I recommend everyone reads this paper that I've mentioned at the bottom of the slide. And what he did was he took the Russell 2000 and he divided it into quintiles of ROIC, and then looked at the shareholder returns achieved by companies that, for example, started in the worst quintile and ended in the best over rolling periods. And as you can see, if you started out as a relative laggard by ROIC, but managed to get yourself to the top of the set, by the end, you generated the best performance of any single cohort. And the inverse is true. If you started with a nice, healthy ROIC and ended in the worst, you underperformed pretty dramatically. So we've really taken that to heart, and we look for instances where companies are posting ongoing self-improvement, hence the title of this talk, which is Kaizen, which is the Japanese word for continuous self-improvement. And now here are a few company examples just to bring this to life that we all own. The first one is RELX, one of our information services companies. 40, 50 years ago, it was selling legal textbooks and very simplistic databases. And over that period, it's used successive waves of technology to make its product even more sticky, even more useful. And on the right-hand side, you've got a product called Lexis Plus AI that can now summarize your cases for you and analyze the track record of the judge you'll be going up against next week and so on. So the self-improvement story here is about owning fantastically relevant content, but then using technology to make it even more useful over time. The next one is our credit scoring company, FICO. And the self-improvement story here is all about pricing power. For decades, they had an agreement with the credit bureaus where they weren't allowed to increase prices, during which time they sold their scores for next to nothing, and they became completely embedded in the US credit ecosystem. And then when they renegotiated with the bureaus from a position of strength, they were then able to start passing through these incredible pricing increases. And at the bottom of the slide, you can see what that has done for the growth rate in their largest segment, scores. I mean, this was a 3 to 4% grower, and suddenly it's grown at 30% compounded. And that has been a really meaningful step change. This one combines two sectors, which are not obvious bedfellows: information services and financials on the left, with RELX and the London Stock Exchange Group, and our media companies on the right. So that's Nintendo and Disney. And the story here is how they have both used changes in distribution to make their revenues more valuable. And the story here is that they have become more recurring and more dependable. So RELX and the London Stock Exchange Group now sell their data under long-term recurring revenue contracts. And Nintendo and Disney are now shifting to this direct consumer model where they monetize their content through monthly subscriptions. So maybe that's the most intuitive example. They no longer worry now about the success of an individual game or movie because they have this closer relationship with customers and money coming through the door every month. And that has made them better companies. And then finally, on the luxury side, the story here, the self-improvement story, has been around profitability. I've shown a decade of results, but we did fortuitously invest in Prada in 2020. And when we did, we saw the potential for margins to go not just to their historic levels around 30%, but even beyond that, in line with peers, if Prada could go on one of these self-improvement journeys and follow its peers in doing more with leather goods, rationalizing their wholesale exposure, actually embracing e-commerce properly, and so on. And gratifyingly, that has already started to happen. And one more note on that one, the power of idiosyncratic turnaround stories is such that the whole luxury sector currently is struggling, and a lot of its peers are either posting negative growth or kind of flat growth. Prada is still continuing to shoot the lights out because it's on this separate journey, and that can be a very powerful foil. It's not all positive. I thought I'd include one here on the other side of the ledger, which is Shiseido. We did invest in this one in the early 2010s. Just like Prada, we saw scope for improvement across a number of measurements. And that did work until the gray bar, which is, of course, COVID. And lockdowns went on for much longer in Asian countries where Shiseido is mainly based. So again, you know, it's on its journey of self-improvement. That margin has a long way to go if it's to get anywhere near L'Oreal and so on. But yeah, we're still feeling the effects of COVID and lockdowns and a couple of years of lost travel retail sales. And that has been painful in the shorter term. But over our holding period, we look forward to locking in some more outperformance again when it recovers. And then just to conclude, this idea of self-improvement doesn't just apply to the companies we own at their individual level. It also applies to us managing the portfolio itself. And we're always looking to make the product into the best possible collection of names it can possibly be. So I thought I'd just give you one example of turnover because they are fairly rare. And we sold a company called JPX, which is the Japan Exchange Group. It's a great company. It has a kind of government-supported monopoly on equity and derivative trading in Japan. And you get a direct line of benefit into the health of the Japanese market, and that has obviously been very strong the last couple of years. But it doesn't have the same kind of growth prospects we would want from a number of our companies, and it is tied to the Japanese market, and that cuts both ways. So we did exit, especially when it was trading at an elevated multiple, and buy in its place a company called Universal Music Group, UMG, one of the three music majors. And the reason here was that we saw a company with superior growth prospects, a longer growth runway, and better recurring revenue mix. And not only that, but trading at a more attractive valuation than JPX. So it was a conducive swap to improving the quality of the Lindell Crane portfolio. So yeah, I'll stop there, and happy to take any questions if we have time.
Ben, thank you very much. Always insightful indeed. Maybe just quickly in terms of, but you run very concentrated portfolios, 20 to 35 stocks. The last example you used, you know, stocks that you maybe won't hold as long. But how do you avoid capitulating on particular holdings? Because if I look at your current holdings, your top 10 holdings, if I look at it a year ago, it's very similar. When do you decide, you know, that a company actually does not work for you anymore? And, you know, how do you then replace it with a new idea?
Yeah, we don't take portfolio turnover lightly at all. So
yeah,
this company that we exited, Pearson, before we left that, it was probably a 2.5-year decision. And in aggregate, we wrote 36,000 words internally, met with 5 different internal people for all the individual business segments, and yeah, felt it keenly. But at the same time, you know, what are we doing day in, day out? Most of the time is spent looking at our existing holdings, but we do have a wish list. And if it so happens that something is seeming attractive and a swap makes sense, we won't hesitate to act. So you just have to be ready for those rare occurrences, but you have to be pretty patient in the interim.
When your colleagues, Michael and Nick, are truly icons in the UK investment arena. And I apologize for this in advance, but I have to ask you, and it's also a question from one of the audience. Your since inception returns, phenomenal. I mean that you stood clients well for decades now already. The past couple of years, even if I look at your 5-year number, you went through a tough time. Maybe unpack that a bit, and why do you stick with the companies that you've got in the portfolio, and why do you think you're still going to be able to deliver on returns in excess or past the MSCI World Index?
Absolutely. As you said in the first question, we're very concentrated. So you can literally look at the individual story for each name. If you take a company like Nintendo, for example, there was a fallow period there of more than 5 years where there was a console that flopped historically, the Wii U, and there was just a kind of earnings trough for literally half a decade. And a lot of people would have been shaken out. We were not, and actually we managed to add at unbelievable prices. And then if you can zoom out and look at the CAGR over 10 years, for example, it's unbelievably competitive. So, yes, 5 years is a decent length of time. But, a lot of our consumer names suffered over the lockdown period. And that has been a drag because that is a considerable weighting for us, always has been. So things like Shiseido and Kao and so on are still in a bit of a penalty box. And then unfortunately, you have companies like the London Stock Exchange, which continue to post incredible results and is a much stronger company than it was 3 to 5 years ago, but it is flat over that period. And when that is a 9% holding, it cuts both ways. So you can feel that absence of returns, even while you're looking at nice fundamentals underneath. So, we do make changes. They have been conducive. FICO has been more than a 3.5 bagger now since we bought it in 2019. So yeah, we continue to look for more names like that and improve the overall quality of the portfolio. And hopefully the next 3 to 5 years are more conducive for some of our historic overweightings to areas like staples.
You've seen it in the past. How many times, if you do have companies or securities that actually do have good earnings growth, that are out there, it takes some time for that value to unlock, or the price to unlock, and be careful not to sell at the wrong time. Very last question: what portion of your returns comes from dividend versus price movement?
I'd unpack it a little bit further and think about earnings growth as well. And we have done all of these calculations. And actually, yes, we do own some dividend paying companies, but that actually hasn't been the biggest factor. And price movement definitely hasn't been the biggest factor. The vast majority of our total return, if you get to that mid-teens figure, has been through, honest earnings growth. And that's the way we want to see it, because that's the one you can actually underwrite and have a view on. If anything, we're very conservative in underwriting our positions, and we assume an ongoing headwind from valuation pretty much across the board. We don't want anything to come from that third factor necessarily.
Then hopefully in the next 3 months, when we talk to you again, I won't have to put you on the spot, and we're going to see some really good returns coming through from your fund. I'm confident. A strong company. You've always clients very well. Lindsay Train, Ben, thank you so much for your time this morning. We're really, really grateful, and we'll chat to you again very soon. Thank you.
Bye. Thanks very much.
Right, today again we will cover global value, and who better to do that than Andrew Clifton, portfolio specialist at T. Rowe Price Equity Division, looking at the T. Rowe Price Global Value Equity Fund. Good morning, Andrew. Thank you so much for joining us all the way from London. Always great to have you joining us again, and looking forward to your presentation.
Good morning, Eugene. Good morning, everyone. Hopefully you can see my screen, Eugene. Can you just confirm that?
Absolutely perfect. Yeah, perfect.
Perfect. So
Thanks,
in the next 20 minutes or so, I just want to talk about our global value equity strategy and why we believe we're well positioned for the next decade. Firstly, just a few words on T. Rowe Price. We are a global active asset management firm with 1.6 trillion of assets under management. Just over 50% of this is in equities, and that is across the range of value, core, and growth strategies. But we also offer a full suite of fixed income and multi-asset capabilities as well. What we look to do is to continually invest in our capabilities and people, especially our investment professionals. And in particular, our fundamental research analysts are absolutely critical to all of our strategies. They are the lifeblood of the equity and fixed income strategies, and global value is a great example of this. So before turning to the outlook, let me just spend a few minutes on this fund. So this is the T. Rowe Price BCI Global Value Equity Feeder Fund. It's Citywire rated gold. We are benchmarked against MSCI World, but we're very much focused on delivering the best 80 to 100 value ideas that we can find on the global stage. Total assets in the CCAV are just over $600 million. We have total strategy assets of about 1.3 billion US dollars. It is primarily developed markets, but we have scope also to invest in emerging markets opportunistically. The investment philosophy of this fund is really to exploit the market anomaly, but a lot of investors do not like controversy. Whenever we have fear and uncertainty, it typically results in the share price becoming more dislocated from its core intrinsic value than is merited by the reality. In order to assess where the best opportunities are, we use insights from the global analyst platform that we work extremely closely with. The first point of call is really to make sure that any perceived problem can be resolved. Value investing is littered with value traps. Companies can appear to be very cheap, but they can be cheap for extremely valid reasons, and they can get even cheaper. We need to be sure that where we're presented with an attractive seeming opportunity, that the problem can be resolved and that the situation can have meaningful upside. Because essentially we're focusing your money on the most asymmetric opportunities. There will always often be downside remaining, particularly in lower quality value names. But if that can be counterbalanced by multiple degrees of upside, then the name can be considered for inclusion. The critical thing when assessing this from a risk perspective is that the potential remaining downside will determine the position size that we take, but we can still take a position if we feel that it is being typically at least 3 to 1 rewarded in terms of potential upside. And perhaps the single biggest differentiator of our fund versus many of our value peer group is that we look to implement this strategy across the value spectrum. So we invest in both higher quality and lower quality companies. Different types of value are effective at different times, and we look to deliver a less volatile pattern of performance than many of our value peer group. And we feel that this way of investing is a critical component of that. And let me just spend a few more comments on this point about investing across the value spectrum. Typically, around half of our portfolio will be on the left-hand side of this page in defensive, very often higher quality value opportunities. These will be in sectors such as consumer staples, healthcare, utilities, but they can still have perceived problems. For example, a regulatory company may be under a utility company may be under a cloud because of a perceived regulatory issue. A pharmaceutical business may be trading at a low valuation because the market has concerns about its drug pipeline and the ability to offset erosion of any blockbusters that it has in its portfolio. These companies, though, are generally relatively immune from the economic cycle and can also have good quality characteristics. They can have good products, good management teams, and generate ongoing levels of cash flow that can be reinvested at attractive rates. So around half of the portfolio on average will be in these types of names. But we trade quality for upside. And we go over to the right-hand side of this page, taking on more cyclical risk, very often lower quality companies, sometimes with more stretched balance sheets, perhaps management teams that are less proven in the market's eye, and ultimately investing in deep value companies. And these, as I've said, are lower quality entities, but they can still offer very attractive returns. Individually, they are tightly controlled from a risk perspective. The level of downside remaining will determine how much of a position we take. And these will be amongst the smaller individual positions in the portfolio. But collectively, these cyclical and deep value companies will be the corresponding other 50% of the portfolio. And the exact allocation to the different types of value will evolve over time according to where we find the best opportunities, but we will always have a persistent allocation across the value spectrum because different types of value work at different times. We never want to be dependent upon just one view of the market environment we're moving into for the next 2 to 5 years. And also we can exploit the great breadth of insights as well as the depth of analysis that our fundamental research platform undertakes. If we look at how we're positioned currently, you'll note that our 3 most active sector allocations against our benchmark are financials, materials, and energy. And these are very much being driven by the attractive stock-specific opportunities that we can see in these sectors. But as I'll discuss in a moment, over the next 5 to 10 years, we feel we are moving into a world of higher rates, higher oil prices, higher commodities, greater industrial investment. And generally, these sectors are very well placed for that environment. In terms of our biggest underweights, perhaps no surprise, but it's those more growth-oriented sectors of consumer discretionary and information technology. But we can still find opportunities in these sectors, just less than the benchmark representation. For example, in IT, we have a good allocation to more cyclical parts of technology, such as semiconductors. Some of these names have clearly been performing very strongly, and we have been lessening our exposure, but we still have quite a decent representation. In terms of more recent changes to the portfolio, we have been adding a bit into utilities. For example, an investment in the UK regulated utility company National Grid. We've been taking a bit of money out of industrials, companies such as FedEx in the US. And that really is illustrative of the fact that we find that more defensive parts of the market may be giving us more opportunity at the moment in terms of current valuations and likely business momentum over the next 12 to 18 months. But we still look to have a good broad balance of exposures. In terms of our regional exposures, on the right, you can see that we have a big underweight to the Americas, that is principally the United States, which at 70% of our benchmark is clearly the most dominant country exposure. So we're underweight the US, but we still do find a lot of good opportunities there, particularly in sectors like financials and utilities. It is just that in other sectors, particularly the very large IT sector, we struggle to find many value opportunities. So let me now turn to the outlook. And as I mentioned, we do have clear exposure to higher rates and commodities in terms of our current allocations. And I think it's interesting just firstly to step back and look at a very long-term history of how different market environments have evolved. And on this page, we're showing for almost the last 100 years for the US market, but it is true on a global basis as well. We're showing a number of high-level factors. Firstly, the green line, as you can see, is showing the relative performance of value versus growth. So value clearly has been a winning philosophy for many decades over the last 100 years, clearly not so for the last 20 years or so, but for reasons that maybe we can discuss, we feel the last, that period has in many respects been an abnormal period. in terms of deflation and low rates and some structural shifts. Going forward, we feel we are in a world of certainly a normalization of interest rates, and you can see on the page as well, we show the long-term nominal yield for the US marketplace. The other point I would highlight is we've overlaid when we have had commodity bull markets. And again, that was a very positive backdrop for value investing in both the 1970s and also the earlier years of the current century. And essentially, we feel we are now on the cusp of a similar positive environment over the next 5 to 10 years. And really just some factors that we feel will be the determining influences upon investment performance for the next decade or so. Firstly, the commodity complex generally. We do feel that energy prices and commodity prices are heading higher in the longer term, not necessarily for the next 3 to 6 months. There are clearly some headwinds in terms of demand and supply, but not least the decline in productivity that we can see in the energy market, we feel is a structural, sticky, long-term inflationary influence. In a similar way, we expect markedly higher levels of investment across many industries. We have seen in the past couple of decades low levels of investment, and going forward, that needs to be addressed. But also critically, there are a lot of very important areas of investment to meet areas such as the green transition and the need to decarbonize across many different companies and many different industries. And this gives both opportunities for a value investor, but also represents a lot of risk because some companies will not have access to the right technology, management teams will make the wrong decisions. So this is very much a situation where active global value management is required. Passive investing, we feel, carries a great deal of risk. And then although we're more focused on the stock-specific opportunities, one cannot lose sight of the macro considerations. As we've mentioned, we feel that the path of interest rates is very much now one towards a more normal picture of positive real rates, of nominal rates being comfortably ahead of zero. Clearly, in the short term, rates are likely to be heading lower, but perhaps when we look back in 12 to 24 months' time, people's current expectations may well have been disappointed if they were hoping that rates would move dramatically lower from here. We feel that there are these structural inflationary forces. And there was also a high and rising level of government debt and deficits that the market will need an adequate compensation for. A final inflationary factor that I would emphasize is the move away from the efficient frontier as supply chains are being restructured, as countries look to have more reliable sources of energy supply, as companies and countries look to make capital allocations on the basis of security of supply and for geopolitical reasons. This is encouraging duplication of investment, and as I said, is likely to be a less efficient allocation of resources than we have seen in the past. In the time remaining, let me just spend a few more minutes on some of these individual factors. And a critical factor to us is that the energy industry, we feel, is entering a period of declining productivity. For much of the last 15 years or so, productivity has been increasing. The marginal cost of a barrel of oil has been lower, and that has clearly encouraged a lot of supply. It has been a negative backdrop to the sector. But because of both resource depletion and also technological limits, we feel that we are now on the cusp of declining productivity in the oil market, and that is a positive backdrop for the energy sector. As the marginal cost of extraction, the marginal cost of supply increases, then that is a positive tailwind for energy companies. And although the green transition is happening, traditional fuels are going to remain a very key requirement for industries and economies for several decades to come. This also has wider implications. Higher oil prices feed directly through into commodities more generally, given the importance of the energy cost. in their supply curve. And also we are seeing other inflationary forces across the commodity industry, not least an increasing social dimension as many communities object and frustrate companies' expansion plans as they look to mine and extract more resources. Historic underinvestment I mentioned, you can see here, but across across two key industries, oil and mining, companies have not been investing because largely the market was telling them they were more interested in the return of free cash flow and not continuing to invest. That is now changing, but companies need to address this significant shortfall. And also, again, to reiterate, but as we decarbonize economies around the world over the coming decades, so much of the existing emissions are in traditional sectors, very often value-oriented, and this is where a very high level of investment will be required. By way of illustration, just in the clean energy world, a figure of over $4 trillion per annum is estimated to be required, which is a multiple many, many times of what has so far been invested. In closing, let me just highlight two further points. Firstly, hopefully the fundamental merits of value investing or the fundamental appeal of allocations to value, I've highlighted some of the key ones, but the key perspective as well is that the valuation for value still remains very attractive. You are not overpaying to take this exposure on board. And on this page, we look over almost the last 50 years at the premium that has been allocated to growth stocks relative to value stocks. Again, it is just for the US market, but it's true of what we see globally. And you can see that we're still well ahead of the median level for the last 50 years or so. Currently, growth stocks are being appraised at almost a 70% premium to value stocks. So, clearly growth stocks have better fundamental prospects, but we believe that the market is underpaying for the embedded value within the value universe. And my final comment will be just on performance. Here you can see the performance of our CCAP fund since inception in 2012. For a value fund against a core benchmark, as shown in the middle of this page, we've broadly kept in touch, and that is largely due to the allocation to value ideas across the value spectrum. We deliver a less volatile pattern of performance than you will see from many value managers, but you'll also see at the bottom of this page that we have achieved a good level of excess returns on a consistent basis versus the value benchmark. And in closing, let me just summarize. Firstly, investing across the value spectrum, we believe, enables us to invest in a lot of attractive value ideas, but to deliver a less volatile pattern of performance than many other value managers. Fundamentally, we are in a new age that makes investing in value a lot more of an attractive proposition. The outlook for rates, inflation, and individual industries has fundamentally changed compared to what the market has been used to for the last 5 to 10 years. And you are not paying a high price to take exposure in this regard. Relative valuations for value are still quite depressed relative to certainly the growth part of the marketplace. So let me stop there, Eugene, and see if you have any questions or if anyone has any comments that I can address.
Andrew, the world is definitely changing. I do agree with you. I mean, we've been in one of the longest business cycles ever for probably about 13 years. And we are likely to see a lot of changes when the first rate cuts come through. Andrew, I asked you this question probably about 6 or 7 months ago. I mean, T. Rowe Price, magnificent firm, massive. You manage multiple strategies, $1.6 trillion US, as you mentioned, strong teams on many fronts, including the value team. The discussions that you have internally at the moment on growth versus value, did that change, or the rhetoric change over the past 6 months on some of those internal conversations?
Well, the first point I would really emphasize, Eugene, is that all of our very skilled portfolio managers have to remain true to their particular mandates. So we do not look to influence either value managers or growth managers as to how they invest. Each are, and just as For this fund, we believe that value investing can offer very attractive returns. There also clearly are extremely skilled growth managers in both our firm and also elsewhere, and we're hearing from some of them today on your call. What I would highlight is that our asset allocation team, who look across equities, but also other asset classes as well, they have an overweight allocation to value relative to growth. And that has been in place for the last couple of years or so. And it is really been driven by the fact that value is relatively cheap, but also the fundamentals we feel have changed. The last decade was the abnormality. We're going back to a world where rates are more normalized, where real rates are positive. Inflation is likely to prove to be stickier. It is hard to make a call on the economy, but it looks as if we may have some slowdown currently underway, but we're not making a case for a hard landing by any means. So it's really an aggregation of those factors that leads those kind of more central, dispassionate observers of opportunities across the different capabilities to make more of an allocation to value currently than they are doing to growth relative to their benchmarks.
In terms of value, where you see some of those value opportunities, are some of that based in emerging markets?
They really are around the world, and it's very stock specific. We currently have about a 5% allocation to emerging markets, but I think the key point, Eugene, is that as we've seen a great deal of rotation and activity, both in terms of, if you like, the higher level, particularly in early August, when we saw the Japanese market, for example, going through incredible turbulence. That is for now appears to have been resolved and seems to have been driven more by technical factors than fundamentals. But we need to be alive to emerging opportunities, either in emerging markets or developed markets. And Japan, I think, is a very interesting case in point. And it was very interesting hearing our previous speaker. One of the stock examples he gave was Shiseido, which was a stock that had not worked out, that has declined quite appreciably. The valuation has come back as its fundamental performance has been hit by COVID and other considerations, and that has now appeared in our global value fund. So we are always extremely alive to opportunities, and I think that is why having such a broad research platform means that we can very quickly identify opportunities as they emerge, and if they meet our criteria, then we can add them to this fund.
Definitely something to keep your eye on going forward. Question from the audience very quickly on fee. Andrew, I'll address that online quickly. We've got a feeder fund here. The feeder fund, the service fee is 25 basis point. The TIC includes the fees of the underlying fund as well. So you've got to add the fund fees of the feeder fund and the underlying fund. I think that's why you're getting to that TIC. Andrew, thank you so much for coming online again. Really great to have you on board, and we look forward to entering into discussions with you again in the very near future. There is a question on where do we find information on the various funds. So the feeder fund on the Boutique Managers website is also a link to T. Rowe Price as a partner directly to their site, where you can find information on all their funds and all the products they offer as a business. If you're not sure where to find us, give us a call and we'll get you to the right place. Andrew, again, thank you so much for your time this morning.
Thank you.
Always great to have you. Fantastic. For our next session, we've got Sands Capital looking at global growth and emerging markets. As they're based in Arlington, just outside Washington, D.C., it's always very difficult to get them online because of the time differences. So we did make a pre-recording from one of their portfolio managers, Tija Boy, one of portfolio managers at Sands Capital, and we'll play that recording quickly. If you do have any questions on Sands Capital, you're more than welcome to still post it and send it through, and we'll get it to the Sands Capital team and get answers on those questions to you as well. Just make sure to mention who you are so that we know where to direct those answers to. Avi and Olga, thank you. We're ready if you are.
Hello, everyone. My name is TJ Boy. I'm one of the portfolio manager for our emerging markets strategy here at Science Capital. The emerging market portfolio is available on the BCI platform. Science Capital is an investor in leading growth businesses across the world, US, developed, and emerging markets. And just to give you a sort of high-level overview of our approach and process, we seek to identify businesses with sustainable above average growth, own these businesses in concentrated conviction-weighted portfolios, accept short-term market volatility in exchange for long-term growth potential. And the reason underpinning this approach is because we believe that over the long term, earnings is what would ultimately drive the valuation of a business and stock returns. And so we believe this approach maximizes our opportunity, our chances of finding these exceptional businesses that have delivered disproportionate, a disproportionate share of returns over the long term. India is one place where we think is a fertile ground to find these exceptional businesses that can compound excess returns over the long term. And so I want to turn my attention to talking about India over the next 10 minutes. So just for some context, Science Capital has been invested in India for over a decade, starting with our global strategy around 2008, 2009. And then with our emerging market strategy, which we officially launched at the end of 2012. As an investor myself, I have been at Science Capital for the last 10 years or so, focused mostly on emerging markets. Before Science Capital, I spent about five years as well looking at emerging markets. So my combined experience as an emerging market investor is over 15 years. India remains a big part of our emerging markets portfolio. And over the long term, as this chart demonstrates, it has outperformed the MSCI EM benchmark. And we believe, and the chart at the bottom illustrates that most of that performance has been driven by superior earnings growth, which is consistent with our investment philosophy. So let's talk a little bit more about the India macro backdrop and why we find it so attractive. There are a lot of things that you would have heard already about India's attractiveness. It's a huge economy, a large population, young population. It's an economy that's seeing a massive expansion in the size of the middle class and rise in consumer spending and consumer aspiration, which supports the growth of various businesses across sectors. But one aspect of India's growth and development over the last 5 to 10 years in particular that we believe doesn't get talked about enough and probably underestimated is the infrastructure build-outs that India has experienced over the last 5 to 10 years. And when we talk about infrastructure, people's identification of what is infrastructure is usually physical. People think roads, bridges. We think that's important, and that definitely has happened in India, as the charts on the slide show, the massive expansion of the national highway network in India. But we believe what has reinforced the infrastructure build out in India and has had probably an even more transformative impact on the economy has been the digital infrastructure expansion in India. So let's talk about digital infrastructure in India. So when we talk about digital infrastructure in India, we're talking about 3 layers of it. There is an identification layer, and this relates to the Aadhaar system which the India government set up. It's an identification system that now includes almost all adult individuals in India. It's a unique digital ID which allows businesses such as financial services businesses to be able to verify with confidence the people that they are dealing with, and this has facilitated massive financial penetration. Another aspect to digital infrastructure in India is the payment infrastructure called UPI, Universal Payment Interface. That's the Indian government set up that facilitates payment transfers between individuals, um, between corporations, and between government entities and individuals and corporations. And then another aspect, another interesting aspect of digital infrastructure is the data itself. The government has digitized most data in India and has allowed third-party players to come in and share that data using different business models across different users. And so companies can access consumer data across different channels. And so this has allowed them as well to be able to tailor products and services that are more appropriate for consumers. Just moving on, this chart is an illustration of how the impact of infrastructure development in India over the last several decades. So one side of the slide, you see a part of Mumbai, India's commercial heartland, in 1990 versus what it is most recently in 2023. And clearly, you're seeing an area which was almost uninhabited now seem more like a densely populated urban area. And we believe this is a combination of physical infrastructure expansion in terms of electrification, road network, telecom network, but also digital infrastructure that has made many part of this India that were once inaccessible, both physically and digitally, now much more accessible. And so people are more confident in living in this part of India. This next slide is just a pictorial representation of how physical and digital infrastructure has penetrated deeper into India. For example, children in a village watching TV, people in an open informal market being able to make payment using their phone and making payment through a QR code facilitated payment system of Paytm. So Paytm is a leading payment platform that facilitates QR code payments, allowing hundreds of millions of people with mobile phones to make payments just using their mobile phone devices. Moving on to why all of this matters and the investment implications. So the integrated development of infrastructure in India across physical and digital infrastructure is forcing an acceleration in the formalization of the economy and also a greater participation of private enterprises. So let's talk about formalization first. So formalization, informality has been an enduring feature of India's economy. So many sectors that we have studied are still dominated by informal players. So when we talk about informal players, we're talking about mom and pop small businesses, and some of these are not even registered for tax purposes. We see that as a big feature of the consumer space. So grocery retail in India is still dominated by open markets or by small kirana stores in India. And so the increased digital penetration of India, increased infrastructure and accessibility of most sectors has forced these sectors to become much more formal. And that is a benefit for many of the businesses that we invest in or seek to invest in. The other aspect of India's economy that has been enduring is the fact that most sectors of the economy continue to be dominated by the public sector. So when it's a public sector, government-owned enterprises, usually referred to as PSUs in India. A good example is the banking sector, where the public sector still controls about 2/3 of the assets in the industry. And this is about 3 decades since that sector was privatized and open to private players. So we believe the increased formalization of India's economy, the increased privatization of India's economy, not only increase the addressable market for private enterprises that we seek to invest in, but also create an opportunity for them to gain market share over a very long time. And moving on to our investment approach and philosophy, and how this relates to India. So first of all, we can observe that over the last decade, a handful of businesses, in this case 26 businesses, have returned 200% or more versus 41% for the average business in the India benchmark. And the other aspect to it is that just barely 4% of businesses accounted for more than 50% of the increase in the benchmark over the long term. And what that means for us is it reinforces our conviction and validate our investment philosophy and approach in being highly selective. So when we look at India, we're not just thinking from a top down, this is a very attractive economy, but we also want to find those exceptional bottom up businesses that are dominant, leading businesses in their respective space, and have the greater chance of delivering above average earnings growth over the long term. And we believe that is what would drive their superior returns versus the average business in the benchmark. And if you look at our current investment in India, it's quite diversified across several sectors in financial services, healthcare, materials, industrials, and consumer, both consumer staple and consumer discretionary. So really quite diversified. And that is something that we really like about India. It's not only that it has a good top-down macro story, which we find very attractive, but we also find very attractive bottom-up stories across sectors that we can own in a diversified portfolio. And one final comment to make about India is that the country just concluded its general elections in early June, and we're very happy with the fact that we're likely to have a continuity in economic policies over at least the next 5 years, and likely beyond that, because the incumbent BJP-led alliance returned to power with the majority control of government, and most of the key ministries of government have also been allocated to BJP party members. So we believe that the favorable policy environments that we've experienced in India over the last 5 to 10 years are likely to continue, and that make us very constructive on the medium to long-term outlook for. At this point, I'd like to say thanks to all of you. I appreciate you giving your time to listen to our thoughts on India. We believe India is an important part of our portfolio, and is likely to remain so into the foreseeable future for all the reasons that I've discussed. I hope to reconnect with all of you again in the future. Thank you.
Olga, many thanks for that. That was Sands Capital, and we're moving on swiftly. Somebody that online already that needs absolutely no introduction, Greville Ward from Fundsmith. We all know Greville. Greville, you're part of our family already. Good morning. How are you doing?
Very well indeed, Eugene. Thank you. Thank you for having me. Talking to you from London today. And I just want to check something, Eugene. Given that I'm the last speaker, can I talk for an hour and a half? Because I have a lot that I want to get off my chest. But I just want to check the rules.
If you could pack that hour and a half into 20 minutes, you're more than welcome.
I'll critique all the previous speakers if you want. No, I won't do that.
Thanks, Greville. Thank you for joining.
I think you've got my slides, or Abby has. If you could very kindly put them up. There we go. Fantastic. Well, thank you very much for that. Hello, everybody. Welcome. I'm going to just whiz through in 15 minutes or so what's been going on at Fundsmith the first half of the year, and happy to take questions online or afterwards at the end of the talk. If we could go on 2 slides, please, past the disclaimer. There, perfect. So that is what is going on so far this year. The fund to the end of July was up 5.9% in sterling. It's actually done reasonably well so far in August, so we're actually up 7.7%. In any regard, we are still behind the market. for this year, which is disappointing. But just to remind people, we are not trying to beat the market in every reporting period, and we're not expecting to do that either. When we started Fundsmith a long time ago, somebody said to Terry, what sort of return do you think the fund will produce? And he said about 12% a year. That was his guess, based on the free cash flow growth of the underlying companies that we own at the time was about 6%, and the free cash flow yield, our valuation measure, was also about 6%. Adding the two together, you get to about 12. And if you look over on the right-hand side of the screen, on an annualized basis, in sterling, we've done about 15 a year since we started. And that number in dollars, by the way, is about 13 because it's been helped by weaker sterling. But that is a little better than the market, which in sterling's done at 11.2. So the fund is doing kind of what we think it should do. The current free cash flow growth is between 8 and 9%. The long-term average free cash flow yield is about 3. Adding those two together, you get 11 or 12. So all roads lead to Rome in some sense. We think this fund should produce a sort of low double-digit return in high-quality equities with less risk than the market. If you look at the right-hand side, the Sortino ratio of our fund is higher than the market. And that is kind of what we're expecting to do. The fund is not really expected to produce 20, 25% a year, kind of irrespective of what's going on in the market, because our companies are not growing at that rate. But we still believe that 12% or so a year compounded in a high-quality portfolio of equities is an attractive return. If we can go on a page, please. This is what's working, what isn't working so far this year. I probably don't need to say much about weight loss because you've all read lots about it, Novo Nordisk. I would just highlight two things. One is we're at the very early stages of that story, just because the drug is only approved, this is Ozempic or Wegovy, approved in a very small number of countries as yet. And Eli Lilly obviously has to have the competing product in Mounjaro. But every other drug company in the world is trying to get into this space because weight loss is an enormous addressable market. And so we are at the very early stages of this story. I think just from a weight loss point of view, this has got a lot further to run. All the countries that aren't currently getting the drug will start to use it when they can. The second thing to say is the additional health benefits of taking these drugs. The thing, Novo's drug is already passed for cardiovascular health, but it's being tested for liver disease. Certain women who are on the drug are saying that they're becoming more fertile than they were before. They are also going to test it for Alzheimer's because they've seen changes in people taking it and getting Alzheimer's. There are also several people at Fundsmith are on the drug, and they've sent us blood work from 4 years ago and blood work today, and all of those measures, they are doing better today than they were 4 years ago. So it's not just about weight loss. The drug, Ozempic or Wegovy, has other health benefits. And I'm only mentioning this because it's people keep saying to us, well, is it all over in Novo? Were you tempted to sell it, or is it gone as far as it's going to go? This is really just the beginning of the story, we think, in weight loss and health benefits of taking weight loss drugs. I don't have much to say about Meta, Microsoft, and Alphabet. Stryker, which is hips, knees, orthopedics, is just basically making up from a period during COVID where people couldn't go and have those kind of elective procedures, but now they are getting into the hospitals and having them done, which is why Stryker's been doing quite well this year. On the right-hand side, those that haven't worked particularly well this year so far, as Terry mentioned in his semi-annual letter, there is a sort of Chinese theme running through this. China not doing particularly well at the moment is not helping, particularly L'Oreal, Nike, and to some extent Brown-Forman. But other than that, I don't have anything brilliant to say about the detractors on the right. If we can go on a page, please. Hopefully we all know by now, because I've banged on about it forever, that is the Fundsmith process. We only try to invest in good companies. We try not to overpay, and then we do the hardest thing of all in active fund management, which is nothing. Let's go on another page. This is how we prove that we do own better companies than the market. Return on capital employed, we think, is the most important measure. If you look at the last 7 or 8 years, our companies have return on capital of 28, 29, 30% or so, the S&P 18 and the FTSE 17. But also, particularly important in the last year or so, we like companies with high gross margins, 62%, 64%, something like that. It's pretty amazing that the companies that we own have gross margins like that. Amazing because the average start date of the companies that we currently own in the portfolio at Fundsmith is 1915. So if you think these companies have been going for that long, in some cases longer, obviously, and everybody's trying to compete away their margin, but they still have some reason why they can retain their advantage. That is the old Warren Buffett moat, but it could be brand, it could be distribution, it could be all sorts of things. But it's incredibly important that these companies have these very high gross margins. It's because, as happened in the last 18 months, if input prices go up or interest rates go up, they can absorb those without losing their profitability to any great extent. But also, it usually means they have pricing power and that they can increase prices in order to get top line growth if they need to. They can't do that indefinitely, but high gross margins points to the fact that they have a very powerful marketing position within the market. And that gross margin of 63, 64, substantially higher than the S&P and FTSE, and the companies are better as well on the other three measures on that page. So we believe we can say to you, with a hand on our heart, we own better companies in the market. We know that they're all growing and compounding. We know that all the companies we own are bigger today than they were yesterday. They will all be bigger tomorrow. And so long as we can go on saying that, so long as those companies can go on growing and compounding, whatever's going on in the macro economy, then we should be fine in this fund. And you as an investor in the fund, likewise, should be okay. If we just go on a page, please. This just shows what I mentioned a moment ago, which is that the free cash flow yield of the fund is 3%. The free cash flow yield of the S&P non-financials, 3.7. So our portfolio is a little bit more expensive than the S&P, but given that we own better companies in the market, we're not terribly concerned about that. If you look at the bottom of the page, the most recently reported, or the 12-month trailing free cash flow growth was 14%. That is a little bit elevated because of post-COVID world that we live in. But as I mentioned, also, since we started 13 years ago, on average, the companies that we own have grown their free cash flow by between 8 or 9%, and we'd be pretty happy projecting forwards that that's what we're going to continue to do. So if you have free cash flow growth of between 8 and 9, free cash flow yield of about 3, that gets you to a return of about 11 or 12. All other things being equal, which they never are. But that's the sum that we do every day to make sure that we think the fund is an attractive place to invest. Okay, let's move on. In terms of activity, we bought 2 new companies this year, Texas Instruments, which makes chips, not the exciting chips that NVIDIA designs, but boring chips that go into analog chips that go into cars and fridges and household items. They're going through quite a large expansion at the moment in terms of manufacturing capacity, which has slowed the growth, which to us, we believe, has given us a very good opportunity, entry point to get into this company. And that's why we bought it this year. Atlas Copco is a Swedish company which makes air compressors, refrigeration equipment, other industrial equipment. Started in 1873. There's still a sort of family control of family shareholding, which we like. I think in both of those cases, particularly perhaps in Atlas Copco's case, it on first reading looks a little more cyclical than the things that we would normally invest in. But I think we come to the realization that everything that we own is cyclical, much as we try and buy things which can make a positive return even in a recession. There is a cyclicality to everything we own. And I think our feeling in Texas Instruments and Atlas Copco is that they are such high quality businesses, we shouldn't not own them because they might have a brief period where the economic cycle turns down, where they are growing less slowly. We haven't sold anything to fund those purchases, but I think, as Terry mentioned, recently we have been reducing our exposure to food and drink stocks, essentially, particularly alcohol. We do think that there is the beginnings of an effect of the growth rate of spirits companies from the weight loss drugs. And yes, only a comparatively small percentage of the population is taking weight loss drugs. But if you know anybody on Ozempic or Mounjaro, you really don't feel like drinking alcohol. And this is not a big long-term problem necessarily for the spirits companies, but we don't think that they are really addressing it or looking at it. They're almost denying that it is a problem for them at the moment. And particularly in premium brands are drunk by rich people, essentially, or people with assets, with money. The weight loss drugs are quite expensive at the moment, and so they're only being taken by people with money. And so we do think at the premium end of the spirits market, there is an effect, and it's not really being addressed by the spirits companies. So we have been reducing our exposure to those in order to fund the purchase of Texas Instruments and Atlas Copco. If we could go on, actually, 3 slides, please, to the sector split. Yes, there we go. this really hasn't changed very much in the last few times that I've spoken to you. As you will remember, we pretty much only invest in 3 sectors: healthcare, consumer, and old line technology. Why? Because we as the consumer use those products or services every day, irrespective of what's going on in the world economy. We still brush our teeth, feed our pets, log into our Outlook, whatever's going on in the world, and that's why we like them. And just a brief reminder for people that this is not a top-down view that we decided, let's look at these 3 sectors and try and find some good companies. It's a bottom-up view, screening 64,000 securities on Bloomberg, trying to find companies that we can buy and own for a long time. We've only found companies that fit the quality screen that we put them through in these 3 sectors. And we own 27 stocks in the portfolio currently. We have 83 companies in our investable universe. We're always looking for the 84th company to put into the investable universe, but we haven't found it yet. So we honestly only believe that there are 83 companies that are good enough to own in the public markets, because the best companies in the world are probably private, not public. But in the public markets, we have found 83 exceptional businesses, and we are invested in 27 of those today. And last slide, if we can go on one more, the geographical split also hasn't changed much since we started the fund. We have 70% or so companies invested in the US. Again, that's not a macro view of the US economy, although we do like the US and the US economy. It's much more that if you happen to want to invest in tech, healthcare, and consumer, you're going to find the biggest and best companies in the world based in and listed in the US. We care much more about where companies are doing business. And on the right-hand side, you'll see that less than 50% of the turnover is in North America. We do have a slight sort of penchant for Northern European companies, Denmark and Sweden. Particularly, we think that Northern European managements are quite conservative. They're very good managers of businesses. And we can find companies that have interesting family shareholdings where we feel that we're aligned with the original founders or the families that own shares in the company. And if you get into bed, if you use the expression, with the right family holdings, you can do well with those. And so we have sort of more than average in Northern Europe. But other than that, the rest of the fund is in developed Europe and or the US. I'm going to stop there, Eugene, in time as usual, and I will answer questions if you have any, or I shall not. Up to you.
Trevor, always precise, very clear story. We got to know your storyboard quite well. It's just some of the numbers that change. We understand Fundsmith extremely well. There's one question from the audience, and it's with regards to Starbucks. You previously owned Starbucks. I think you sold in 2022.
Yes.
In inverted commas, you sold it due to missteps in management
Yes.
and capitalization. With new leadership in the company, is it becoming appealing again for Fundsmith or not?
Yes, it's a good question, and the person who asked the question is entirely correct that we sold it in 2022 because, in all honesty, we knew the person who'd been appointed from Reckitt Benckiser, not sort of personally necessarily, but what I mean is we used to own shares in Reckitt Benckiser, so we got to know his management style. And when he was appointed, we didn't think he was the right person to run Starbucks. Going from loo cleaner to coffee is not necessarily an obvious switch. And Starbucks also were having trouble at the time in their China business, even though their major competitor, Luckin Coffee, turned out to be a fraud. They weren't gaining ground nearly at the rate that they should in China. The new CEO of Starbucks has done a very good job at Chipotle. And I think he is possibly going to do a very good job at Starbucks. And I think it is more interesting to us, yes. I just kind of, to flesh out that answer a little bit, we're not very reactive at Fundsmith. We don't tend to jump into a stock because a new person's been appointed that we think will do a good job. But if he starts showing progress in the things that we think that the previous management failed to make any progress on, then it is certainly something that looks much more interesting to us now under this new management than the guy that was fired last week. So yeah, it's a good question, and it is more interesting to us. Yes.
Very interesting indeed. Question from the audience, but I think the answer is partly in the question. I mean, we've seen it in your holdings. You do look different to the index being the MSCI. And the audience member saying most quality funds or quality, those who hold high quality companies been lagging, the index being the MSCI ACWI. for the past 2 to 3 years. Any thoughts on this? But I think it speaks to your holdings. I mean, if you didn't hold the Mag 7 in proportion, you back, but you're looking at, where you can add value for clients going forward. But maybe if we could phrase the question like this, is why a big hold away from things like the Magnificent Seven in holding the companies that you're holding?
Yes, I mean, the question is right. We don't own Nvidia. Nvidia, I believe, made up about a third of the S&P return in the first half of this year. So quite simply, if you're an active fund manager and you don't own that, you're going to underperform. But I think that what we try to do, I was just chatting to somebody last week about this, that we bought Microsoft shares at $25 a share in 2012, and we still own them at 420 or whatever they are today. I think that it's worth remembering that what we're trying to do at Fundsmith is find really great businesses that we can buy, hang on to for a long time, where the investors in the fund, in our fund, and us in those businesses can kind of sleep at night, because we think we own really good businesses. They're going to be fine. Whoever gets into the White House in November, whether the US goes into recession the second half of the year, we're trying to find things which we think can grow and compound throughout that period. Now, it's also worth remembering the S&P long-term return about 9%, 9 to 10% it's given you over the last 50 years or so. It's quite likely that that's what it's going to do for the next 50 years. What's happened in the last 2 years is the S&P has gone off the charts. Now, if you think that is something which the S&P will do for the next 50 years, then an index fund in the S&P is the right place to invest. But we think it's more likely that the S&P probably will go back to producing a return of what it's done for the last 50 years of 8 or 9%. And we think we can probably do a little bit better than that, owning better companies than the market, which are growing and compounding. So yes, on a relative basis, it's not been great for the last 2 years or so, but we think there's a tremendous benefit in owning Procter & Gamble and Unilever and Microsoft and Visa, and being able to sleep at night knowing that these businesses are getting bigger every day and will do whatever happens in the world.
No, exactly. Very last question from the audience. We've seen a couple of quality fund managers presenting as well, huge firms right across the globe.
So the last there question... are other quality managers? My God. Sorry, carry on.
Do you think? Well, exactly. So the question speaks to your team. How big is your team? Is all your research being done in-house, and how does it differ to others or other quality managers, if anything?
Well, we don't spend a lot of time analyzing other managers, I have to say. Certainly when we started 13 years ago, there were sort of 2 or 3. We don't call ourselves a quality manager. I'm sorry. We just try and buy the best 27 companies in the world. If people want to classify us as a quality manager, that's fine. But it's not how we think of ourselves. Others have been setting up over the last few years, and it's become a popular place to invest. We get all of that. I think the way that we differ from the others is our screen of what makes a good company is much tighter than the average. So if you look at other funds, so-called sort of quality or quality growth funds, they will own things that we can't get through our quality screen, which is not to say that we're right and they're wrong, but we have a very clearly defined, very tight criteria, and we will not invest in a company outside that criteria. So that is kind of the biggest difference between us and others, is that Terry will not invest in something that he doesn't think is a great business, using all the sort of financial metrics that we look at. And I think that's a kind of stark contrast to some of what some of the others are doing. The investment team is the same team that's been doing it for 13 years. So Terry is at the top, Julian Robbins is our head of research, Daniel Washburn on the research team. We've added a couple of others who are very good and helping along. But the core of the investment team, exactly as it was on November 2010 when we started the fund, and it won't change in the next 10 years. It's the same group of people doing it.
And exactly what investors are looking for, those best companies in the world. Greville, always great to have you on board. Thank you so much for your time once again. And we are going to see you in the very near future again. And safe travels wherever you're going off to next.
Thank you very much. Thank you, and nice to see everybody.
Good stuff. Greville, thank you very much. Big thank you to all our presenters today, all the work you've done and it's gone into this session. It's really fantastic to have you all with us, your audience out there. Thank you for joining. As I mentioned in the beginning, all the recordings will be posted on the Boutique Managers website, as well as their presentations. To the BCI team and Abby from Excel Academy from running the session and making all of these things possible. Thank you very much for that. Just a quick reminder, next week, Wednesday, the third day of our Offshore Investment Managers webinars. Another great lineup for you for an hour and 45 minutes, I think, next week, Wednesday. And we'll see you back then. Thanks for joining. Have a fantastic week further. And we'll chat to you soon.